Hello and welcome back to Principles of Accounting 1. I'm your host, Dr. B. We're going to be talking about cash, fraud, and internal controls. So, cash. We know that cash, when we debit cash, we're increasing cash. And that is a result of the business collecting cash from their customers from sales, whether that be sales that we made directly using cash or previous sales that we made on account and we're now collecting the cash from the customer. When we pay for expenses, we use cash. We pay our expenses using cash. We pay our employees using cash. We pay our taxes. We pay our accounts payables using cash. When we pay cash, we credit cash. Cash is a very fluid, dynamic asset because we can use it for a lot of different things. But that also means that cash is very prone to theft, fraud, abuse, because it's very flexible, right? And so in accounting, it's important that we maintain strict control over cash and other assets to prevent things like fraud. And so that's what we're going to be talking about today. So in order for us in accounting to maintain control over our assets like cash, we establish internal controls within the business. The concept of internal controls is we are setting policies and procedures to protect our assets, to make sure that they don't get stolen or abused or misplaced. We put protections in place for our assets. Examples. Let's say for cash, for example. Many years ago, I used to be an assistant store manager. This is a long time ago, okay? We're talking 20 years. So 20 years ago, I was an assistant store manager. And there was a lot of cash coming into our retail business. Yeah, I mean, that's normal. Customers pay with cash. At the register, they pay with cash or credit card transactions, whatever. So it was for a really big store. This store's out of business now. It was called Sears. Okay. But it was a really big outfit. It was one of the largest Sears stores in the United States. Our store, on average, we used to have $50,000, $60,000 a day coming in cash. Okay, at the peak of the business. It's obviously not like that anymore, but it used to be like that. So we'd have a lot of cash coming into the business. So at the end of each night, it would be myself, another manager, and typically another manager in the safe room, the cash room, counting the cash, verifying the cash receipts, putting it in envelopes, dropping it into the safe. The reason why we had more than one person controlling the cash is to protect the cash. If it's just me in the cash room, things might go crazy. I might decide, oh, my pockets are full, right? So to protect the cash, we have more than one person counting the cash. And for those of you who have retail experience, you know what I'm talking about. Oftentimes, let's say you're working a cash register. You're receiving cash from your customers. At the end of the night, you got to make sure that you have like $100 or whatever in your cash drawer, right? The rest of it gets deposited into the safe in the back office, or you drop it off at the bank for the company, right? So in that process, it's usually not just you counting it. Usually you count it, you put it in your company's safe, and then your manager counts it, right? To verify what's in there is accurate. That's a control process where you put it in a bag, You tape the bag shut, you write your name on it. That's a control process. All of those things help to protect the asset, the cash. What about inventory? How do we protect inventory? We have security tags. We have security cameras. We have the little beeper things at the doors, right? All of those things help to protect our inventory, our asset. What about accounts receivable? How do we protect accounts receivable? We have that in our accounting information system that we talked about the last chapter. The accounting information system helps us to protect our accounts receivable assets, so forth and so on, right? There's so many different methods we use to protect our assets. Internal control systems will also establish reliable accounting. What does that mean? Reliable accounting. It means that the information that was entered into the accounting system is validated. It's valid and reliable information. How is it validated and reliable? Someone else looks at it. There's an audit process involved. They audit the information to make sure that it's correct. We call those auditors. We also, there's usually more than one person entering the accounting information. When I was working at the hotel years ago as a financial controller, I had one person doing accounts payable, one person doing accounts receivable, another person doing payroll, and then there was me, and then there was another controller. So, you got multiple people doing multiple jobs, all working together. That ensures the integrity, reliability, and validity of the accounting information. Internal control systems help to uphold company policies and promote efficient operations. The United States Congress in 2002 established what we call the Sarbanes-Oxley Act. This provided a requirement that all publicly traded companies are audited by external, independent accounting firms. For example, KPMG, PricewaterhouseCoopers, those 2 out of the 4 big accounting firms audit publicly traded companies' financial statements to ensure that they are accurate, reliable, and transparent. The reason why the Sarbanes-Oxley Act of 2002 was created by Congress is to protect investors from being defrauded. What happened was there were major accounting scandals in the 90s and in the 80s, and probably even before then. But in the 1980s and 1990s, there were major accounting scandals. One of the most famous ones that you've probably read about is called Enron, which was a company that dealt in energy. And they defrauded investors by overstating their sales. By overstating their sales, they said that they sold more than they actually did. The reason why they did that was to attract more investors. That's illegal. You can't overstate your sales. That didn't happen. Okay. And so the Sarbanes-Oxley Act was created for those reasons, to protect investors from losing their investment, to ensure that companies are being transparent, honest, and open with their reporting. And so that was a whole concept behind the Sarbanes-Oxley Act.
Professor.
Yes, I want.
Is it the same thing when you understate your sales? Is that also illegal?
It is, yes. Yep. So that's why one of the primary accounting principles is the matching principle. The matching principle states that we must report our revenue when it's earned. That is matched with the expenses when they are incurred. So because of that matching principle, if I understate or overstate my sales, I am violating that principle. If you violate any of the accounting principles, you are breaking the law. So and the Sarbanes-Oxley Act helps investors to be protected from investing in companies that are breaking the law.
Okay.
Good question. Absolutely.
Thank you.
Yep. Excellent question. There is another, as it relates to fraud. This is called the Committee of Sponsoring Organizations, or COSO. COSO developed this framework. The framework helps to guide internal control processes. First is establish the control environment. What is the environment of the business that is being controlled? That's number one. Number two is assessing risk. We assess risk by evaluating riskiness within the business. For example, there is a risk that my gas station might get robbed. Okay, that's a risk of the business. Or the gas station might catch fire. That is a risk of the business. So we assess the risk and then create strategies to mitigate or to reduce that possibility. Third part of the framework is to control activities. We control activities by controlling individuals within the business, by controlling processes within the business, and by controlling the environment. Controlling activities means we are controlling how our employees are behaving on the job. We control the processes by which the employees act, right? So all of those are control activities. The fourth part of the framework is information and communication. How is your financial information being communicated to your stakeholders? Using your income statement, balance sheet, statement of cash flow, statement of retained earnings, all of those financial statements are regulated. The structure of those statements are the same for all companies. The account names might be slightly different, but the way that they're structured are the exact same. That information is communicated to stakeholders in the same way. And the fifth part of the structure is monitoring. We monitor all of the actions taken within the company. And all of these things together establish framework for internal controls to mitigate fraud. The internal control principles used by most, I'll say all, most companies, is to establish responsibilities for individuals, maintain adequate records meaning financial statements and all of the control documents, ensure assets and bond key employees. Okay, so ensure assets, protect the assets, bond key employees. These are your people that are responsible for the control of things like cash within the company. They're bonded. When they're bonded, that means that they're insured. The company's insured. If something happens to those employees or they behave unethically or illegally, the company's bonded. These are protected. There's separate record keeping from the custody of assets. What that means is the same person who is receiving cash should not be the same person who is recording the cash transactions. Divide responsibility for related transactions. I have individuals for accounts payable, accounts receivable, payroll, assistant controller, controller. Individual people with individual responsibilities for the same transactions. That helps to ensure reliability. Apply technological controls. This would include things like security cameras, accounting information systems like QuickBooks, various other technological controls, fingerprint readers, you name it, right? There's a lot of them. And perform regular independent reviews. Have someone from the outside come in and count your inventory. Make sure that it matches what you have on your books. Have somebody come in and audit your accounting statements. Make sure that they are reliable and accurate. When we establish responsibilities, we're looking to make sure that those responsibilities are clearly established. Okay, your responsibility is to XYZ. It should be spelled out. Assign responsibilities to one person or individuals. Yeah, and determine who is at fault. So when something fails, we got to blame someone. Someone must have done something, right? I'm like, oh, $1 million is missing from this company. Okay, that's a red flag. Who took it? Who's responsible for it going missing? Yep. So who's at fault? Maintain adequate records. This helps us to protect assets, helps managers to monitor company activities, and includes things like detailed records using the chart of accounts, printed forms, pre-numbered sales slips, computerized point-of-sale systems. Pretty much the idea behind this is to make sure that all of your records are organized in a logical way. So for example, if I have a customer, the customer comes in, they happen to be number 102, my sales slip says customer 102, and my computer information system says customer 102, I can trace it right back to that customer. So if something goes wrong with that product, I know who bought it, right? So that's one of the many important reasons why we need to maintain those types of records. That's also a great way to tell, like, I'm pretty sure it was this class. We had a conversation, remember, it was about the grocery store. And the grocery store sold bad lettuce. And the bad lettuce went out to various customers. How do we know who bought it? How do we know how many times we sold it? Well, through this process. We can see what was sold, when it was sold, who we sold it to. And so we can contact those customers, or we can say, hey, public, we sold this number, all of this stuff is bad, please return it. That's how that information comes out. Bonded employees. Assets should be insured against losses. We make sure that our company usually has $1 million umbrella policy for various reasons. Most individuals have $1 million umbrella policy. I have one at my house. So if I get sued, like if my deck collapses and 5 people get injured, my insurance will cover up to $1 million. Okay, so the idea behind that is, in the event of a loss, somebody steals your company's stuff, you're insured. Okay, so like when there were riot, in the event of a riot, okay, people are breaking into various places and taking stuff. The company's insured, so hopefully they should be anyway. You should be insured up to or more than the value of your assets. Employees handling lots of cash and other assets should be bonded. In other words, they're also insured. Bonded means the company has purchased insurance policy against theft by that employee. That's what that insurance covers. Second, record keeping. Someone who controls the asset should not have the same control to the accounting records. In other words, if you are the person counting the cash, you should not be the same person entering the receipts into the accounting system. Because you can easily defraud it that way. You can just change the numbers on both sides. That's why it's important to have 2 different people. Reduces the risk of theft or waste. And employees need to be, it prevents employees from colluding to agree to commit fraud. Yeah.
I have a question.
Mark, go ahead.
Why do you say that? Why would you not have the person do the same thing?
Yeah, so that person can lie, right? So like, for example, let's say I'm the same person counting cash and entering the cash receipts into the accounting system. Well, I can say that there's $1,000 less, right? So I will take $1,000 in cash, put it in my pocket, and then enter $1,000 less into the accounting system. Nobody's going to find out until much later, if at all, because the records match. So if the records match, it's difficult for the company to prove that there was a theft. But if there's two different people, it would be very obvious that there was a theft. Does that make sense?
So they basically can catch the person that can.
Yeah, so in other words, one person should be counting cash, the other person should be entering the cash into the accounting system. It should never be the same person doing both.
Professor,
Yeah, go ahead.
aren't those two, like I worked on one end of those. Usually they're in two separate offices, if possible, two different
Right.
states. Like they're so far away from each other that
That's right.
you
Yeah,
can kind of prevent that, right?
that's exactly right. That's the exact reason for that, is to prevent the employees from
So
colluding.
that
Yeah, that's true.
so that makes sense. That makes a lot of sense when a person they're doing the books in DC and the other person lives like in Switzerland or something like that. That makes sense.
Yeah,
I
it doesn't
got
have to
you.
be that far, but yeah, I agree.
Yeah, I remember when I was working at a company, I was a temp and I was actually counting money for an event that they always have every year for like a variety of events. And they would actually put us in a room with a camera while we're counting the money. And they'll be in the outside. The other people will be outside in their computers, working on the other side of things. So yeah, that's how usually it is. One room is used for accounting, and the other one is used for everything else.
That's right. 100% right.
Professor,
Yep.
a quick question. I heard you mention something about like if there's a hack. Were you saying that if there's a hack to a company that there's an actual insurance policy that that insures them for that?
Yeah, in some cases. In most cases, yes. So, like for example, the solar winds hack, or there's another big one that recently happened with the oil company, I guess, or I forget.
Yeah, the oil company
Yeah, I
hack.
forgot the name of that company, but anyway, company gets hacked. They pay a ransom, or through ransomware, or they have, or their money simply stolen out of their account. They're insured. In most cases, up to a certain value, and that value should be above whatever their asset value is. Yes.
So it's just like the credit union. It's like the credit unions and banks and things of that nature. Correct?
Yes, sir. That's right. That's right, Mark.
Okay.
Yeah, exactly. So what Mark's saying is, if somebody hacks your bank account and steals money out of your bank account, you're insured up to $100,000 per account, if through the FDIC. So if that happens, it's all good. At least up until that amount. Yeah, it's fascinating.
So, Professor, are you saying you're automatically insured by the FDIC?
Well, so it depends on your bank that you're with, but in most cases, yes. The FDIC insures most bank accounts up to $100,000 of theft.
Oh, okay.
Yep. Good question.
Got it.
Yep. Yeah, sign at the bank counter, exactly. Yeah, most banks, some don't, but most do. Internal controls. So we separate duties among individuals. The reason for that is because it creates a system of checks and balances. Otherwise, there can be this thing called collusion. Collusion is where two people act as one and they defraud the system, right? In order to prevent that from happening, we have a system of checks and balances. So that's why we spread responsibility across individuals. For example, I have one person counting the cash and another person entering the transactions in the accounting system. Or I have one person paying the bills, I have one person receiving cash, and I have one person taking care of payroll. They're all different individuals with different responsibilities to ensure that there is a system of checks and balances. Sometimes a company will have two people that sign checks, okay, that do the physical signing of checks, right? You'll see two signatures sometimes. The reason for that is to establish a system of checks and balances to prevent fraud and errors. We call this a separation of duties.
I have a question for that.
Mark, go ahead.
So let's say, for instance, I'm working for you, Dr. B,
Sure.
and I'm your secretary, and then somebody else works for you, and they're doing the payroll. So the payroll has to come to you for you to sign the first check, and then somebody else signs as well, correct?
Yeah.
Did I miss something?
Yeah, that's right. Yeah, in most cases. So, like for example, at the hotel, when I was an assistant controller at the hotel before I became the controller. So, as an assistant controller, the way it would work is, let's say we have accounts payable. The person in accounts payable, they entered the bills into the system. When it comes time to pay the bill, they print the check out. Okay. They attach the check to the invoice. They bring that copy of the invoice and the check to me. I sign the check, and then my boss, the general manager or the controller, also signs the check. So what that does is it creates a system of checks and balances. It went through a chain of command to make sure that there were no fraud or errors in the payment of that check. So to answer your question, yes, that's a very similar process.
Okay, I got you.
Cool. Yeah, that's how checks and balances work. Technological controls, cash register, very helpful. It's all electronic. A time clock keeps records of employees' hours worked. Scanners limit the access to authorized individuals. So think of a time clock. So you go into work, you clock in, you clock out for lunch, you clock back in, you clock out to go home. What that does is it keeps track of the hours that you worked. Okay. It's a way of controlling payroll expenses. Cash registers, they track sales, right? So there's a lot of technology that helps us to track our expenses and our transactions. They help us to ensure that policies and procedures are followed. Their audits are done independently, not by the individuals involved. Audits are used to evaluate the efficiency and effectiveness of internal control systems. Audits are typically done by external parties. So, for example, back in the retail business, when I was working for Sears, we would have a third-party company called Regis. Regis is a huge company. They're worldwide. What they do is they're contracted by companies like Sears to come in once a year or twice a year to do physical counts of inventory to validate what's in the accounting system matches what's on the floor for sale, right? And so that's a form of an audit.
Question.
Yeah, go ahead, Mark.
So an audit can work in a hotel when they audit all the hotel guest accounts, correct?
Yes, sir. Yeah, it works the same way. So what they do is they validate the guest charges actually match what they purchased, or what the transactions that happen for each guest, and that's usually done by the night auditor.
So let's say, for instance, you're staying at a hotel. You're on vacation, you stay at a hotel.
Mhm.
You only charge one thing to your room.
Right.
And like, let's say, for instance, I'm not saying this to be, you have a death in the family, you only stay one night.
Right.
So when the night auditor comes in tonight to work,
Mhm.
does that mean that the night auditor only charges your credit card one time, or how does,
Yeah, that's
I'm
right.
confused.
Well, yeah. So what a night auditor does is, obviously they work the night shift, right? That's why they call it a night auditor. So they usually work from like 10 o'clock at night till 7 o'clock in the morning. And during their shift, what they'll do is they'll close out your account. And what they do is they look at your folio, which is the folio is just like an invoice, right? It matches how many nights you stayed, the taxes being charged, did you have parking, did you eat in the hotel restaurant, whatever. Did you download any movies, whatever, right? They look through all of those transactions, validate that they actually happened, and then they swipe your card to close out the account. Your card was already swiped when you checked in, remember? So we need this for incidentals? That card is used when you check out. The checkout process actually happens during the night audit process. The night auditor is essentially checking you out because that's when they charge your card, right? And then then security or night audit desk comes and slips the invoice under your door. So in that process, what's happening is they're auditing your folio, closing it out, and validating all the charges. So in essence, that's why we call it a night auditor. They're auditing the guest folios at night. And they slip it under your desk, under your door in the morning. And then you just walk out when you're done, right? That's why the process is so simple. Does that help to answer your question?
It makes sense, but I'm still confused. But go ahead.
Yep. So that's the concept of night auditing. Another version of auditing in a hotel setting, and I've done this before, is you usually do this with more than one person. Is we had a hotel restaurant, and at the restaurant, typically once a month, I would go down there, and I would audit the liquor, and I would audit the silverware, right? So what we did is we would go down and we would weigh all of the liquor bottles, and we would match what was weighed with the sales to validate that what was sold is missing from the liquor bottle, right? And so that is a form of audit. We're controlling the inventory as well during that process. And so there are several different instances of those types of audits to validate the control process. So let's continue. The idea to use technology, fraud, and internal controls is we're reducing errors. We are providing evidence of processes. We have increased, it also provides increased e-commerce. In other words, more people are willing to buy things online because there are so many control processes in place. More extensive testing of records, separation of duties. All of these things working together help businesses to control helps to establish a set of internal controls, prevent fraud, and use technology. Limitations of internal controls. Every system has their limits, right? The same as with internal controls. Humans still make errors. Okay? Things are not perfect. People make mistakes. I make mistakes all the time. You make mistakes. I make mistakes. We all do. It's part of being human. Sometimes humans can be a little careless. They make misjudgments. They can be confused. I get confused a lot. Human error. Yeah, that happens. Human fraud. Sometimes people are just thieves. They take things. Okay? That's intentional. That's called fraud. Human fraud, triple threat. Opportunity, financial pressure, realization. Opportunity to steal, the financial pressure that people are under, and the rationalization that it's okay to steal. These three things encourage people to steal. So we try to mitigate these three things the best we can. Cost benefit. Cost benefit is the cost of internal controls that must not exceed their benefits. In other words, if I install a very fancy system with security cameras and beepers and tags and all of that stuff, the total cost of implementing that great technology should never exceed the benefit of using the technology. Okay, let's talk about cash. Cash is more fun, right? I like cash.
Professor, I have a question about the
Yes,
last.
please go
So
ahead.
how would you measure the costs and the benefits?
Oh, good question. I'm so glad you asked that one. So the cost is the cost of the actual prevention measure. So it's the total cost of the security cameras, the total cost of, you know, whatever it is that you're installing, right? That's the cost. That is the cost of the internal control. The benefit, how do we measure the benefit of using that? It's difficult to measure the benefit. The benefit is typically measured in the prevention of that theft or that fraud, right? The prevention is the benefit. So, how do we measure the prevention of theft? The security cameras catch the people stealing. That's the benefit. The benefit is the value of what could have been stolen. So, in other words, my security camera system should not be cost more than my assets, right? That's how you measure cost benefit. Good question. Yeah, it's a little bit more challenging than that, but that's the gist of it. Yeah.
But what if no one steals, right?
Oh, come
So
on. No, come on. People steal. Whether you think they don't, they do. People,
I mean, it's the same as having insurance. Like, you probably won't need it, but you're still going to have it because you just don't know.
that's right.
yeah.
Yeah, I would have to agree with Maureen on that. So if they do steal, I mean, the insurance will cover that. Hopefully. Good questions. Yeah, we can go on and on, but it takes a while. Nassim, go ahead. Nassim.
So, all of these, when we talk about Sarbanes-Oxley and COSO, these are all for public companies.
Yes.
Like private companies, I'm just trying to see if I'm right. Private companies can pretty much do what they want because they're
Well,
private, correct or no?
well, no. So publicly traded companies need to adhere to the Sarbanes-Oxley Act and COSO. Private companies should also adhere to COSO. They don't have to follow everything to a T, because COSO is just simply a guiding set of principles, or a framework.
Right.
They don't have to follow that
Right,
framework
right.
exactly. It's designed to help them, right? So there's nothing that says that they have to, but it's there for their benefit. But private companies have to file their taxes. They have to adhere to the accounting principles, because if they don't, all of their stuff's going to be wrong, and then they'll get audited by the IRS and ultimately shut down. So from that perspective, private and public companies have to follow the accounting principles. That is an absolute guarantee that they must do that. If they violate any of those accounting principles, they're ultimately committing fraud when they file their taxes, because their taxes will not be correct. And when that happens, then comes the IRS breathing down your neck, and then comes the year's worth of audit, and then comes the year's worth of bankruptcy. So the short answer is they should follow the COSO guidelines, but it's really up to them to do so. Great
So
question.
there's pretty much no chance, or a very, very slim chance, of a public company defrauding the IRS.
very slim chance of that happening. Yeah, because a publicly traded company is audited by a third party accounting firm, right? And so that third party accounting firm, they'll catch any errors like that. Though most of them will. And in the event that they miss it and their books still get through and to the IRS, if the IRS catches it, then there's even bigger trouble. I mean, it happens once in a while, but yeah, there's very slim to no chance of a publicly traded company getting in a lot of trouble with the IRS.
So another
Thank you.
question.
Yep.
It's like when you do your taxes through
Mhm.
like a third party, like what's the
TurboTax.
TurboTax?
Yep.
So they do the same thing, correct?
Oh yeah, yeah, absolutely. Yeah, and TurboTax works kind of the same way. So, like I use TurboTax for my personal taxes, right? And when I use TurboTax for my personal taxes, I go through all of their checks and balances to make sure that what I entered in is correct, and it matches what's on my W-2. If I miss a number on my W-2 or whatever, if TurboTax doesn't catch that, then I'm in trouble. I'm in trouble with the IRS because the IRS already knows. The IRS has a copy of your W-2. So when you go to file and your numbers don't match what's on your W-2, you're going to be in a lot of trouble because that'll throw a red flag at the IRS to say, oh, this number's inaccurate. And then all of a sudden, here comes the audit letter, right?
So how did the IRS get your taxes before you did? That was my next
Your
question.
employer sends it to them. So
Yeah,
by
it's
law,
their W-2. Like when you're hired, it's one of those things you have to fill out for them to
the
either
W-4. Yep.
oh yeah, W-4 to take out taxes or for you to be like exempt from it.
Yep. So when you're first hired, you complete what's called a W-4 form. That W-4 tells the IRS and your employer what to withhold from your taxes. And so at the end of the year, your employer sends all of your earnings to the IRS. The IRS knows how much you made at the same time you know how much you made at the end of the year. So if you tell the IRS you earned something other than what's on your W-2, I guarantee you will be audited by the IRS.
That makes perfect sense.
I know from experience. Don't ask me how I know. Okay, let's keep going.
Well, not to go off topic, but Dr. B, I will be emailing you something. I have to ask you something off class time, but
Yeah, shoot me an
I
email.
have something to tell you.
All right, cool. Sounds good. Hopefully it's fun and exciting. Okay, control of cash. Handling cash should be separate from record keeping for the cash. As I explained earlier, one individual counts the cash, the other person should be entering the cash into the accounting book separately. Yeah, separate people. Cash disbursements are made by check. In other words, let's say your company allows employees to file a expense report with your company. When you pay that employee back for their expenses, it should be in the form of a check, not cash. That's for record keeping reasons, yeah? Paper trail. Cash receipts are promptly deposited into the bank. Don't be sitting on no cash and no safe. Okay, that's very unsafe. Got to protect your cash. Cash and similar assets are called liquid assets because they can be readily used to pay current liabilities. We use cash to pay our short-term liabilities, as you would imagine. I use cash to pay things like bills. It could be in the form of a check, but it's still cash, yeah? Cash includes things like currency, coins, deposits to bank account, physical checks from customers, cashier's checks, certified checks, money orders. All of these things are considered cash. You could also include things like Bitcoin, digital currency. Those are all forms of cash. Cash equivalents would include things that are short-term liquid investments. These are things that can be quickly converted into cash. Something like that would be a bond, a security bond. Those are quickly converted into cash. And they're close to maturity date and do not have sensitive changes. Example of that would be like a municipal bond or a security bond that you have with a bank, or what they call a CD, certificate of deposit. Those are all things that be quickly converted to cash. The goal of cash management is to ensure that you have enough cash on hand to make your payments when they're due. What a shock. And of keep a minimum level of cash necessary to operate. Now, I want you to understand one very important key thing in business. You must, and I repeat, must. If you have employees, if you're responsible for paying anyone else, any employees, you must have, and I can't stress this enough, it's so important. You must have a separate bank account for payroll, and you must ensure you have enough cash in that account to cover your payroll. Because otherwise, there's going to be problems. Yeah, you need to pay your employees on time. What happens if you don't? They'll sue you. Okay, then the IRS will come down on you hard. Make sure that you have enough cash to pay your employees. Always. So therefore, it is number 2, super important. Keep a minimum level of cash necessary to operate. Operating includes things like paying your employees. Encourage collection of accounts receivables, delay payment of liabilities, keep only necessary assets, plan expenditures, and invest excess cash. All these things will help you to effectively manage cash. Okay, over-the-counter cash receipts. You receive cash from your customers through the register. You enter your sales transactions in the register appropriately. You deposit any overages through the sales department into the cashier department, which translate into the bank statement as they're deposited into the bank. Supervisor records these transactions through the accounting department through the receipt of cash, which also shows up at the bank. Now, all of this is important because cash and sales that you've made through credit card transactions and whatever, all of that shows up on your bank statement, right? So what happens when your cash register is short or over? Okay, it happens. Hey, sometimes I've done it before. I've given customers the wrong change back, or not enough, or they'll say keep the change, right? These things happen. Sometimes we don't give the right change back or whatever, so we make errors. Yeah, that happens. So there's a process by which we record the difference. If a cash register shows that we have $550, but we actually have $555 in cash in the register, we're over $5. So we debit cash $555, because that's how much physical cash we have. We credit this account called cash over or short, and short, by the difference, in this case $5. And our sales $550. What if we're under? Okay, that happens too. Oh, I didn't, I gave too much change out. I've done that before. So we debit cash, $621. We debit cash over short, $4, which is what I'm under. And we credit sales. It happens. Yeah. Cash receipts by mail. Don't ever send physical cash in the mail. You guys know that, right? Don't do that. That's dangerous. Don't ever send physical cash in the mail. I've seen people do it. I'm like, wow.
It's so funny that you bring that up because I've been actually going through old mail, and you know how there's like these certain places where they actually send they sent me money, and it's like one of those donation things for like annual whatever. And then for them to for them to entice you to actually donate, they actually send you like, for example, they sent me $1. So I'm like, okay, like, why didn't you just keep that dollar for your, it's like incentives that they
Silly.
send. So I'm like,
Yep.
why are you guys sending me money?
This silly stuff. Yeah, please don't do that. Don't put physical cash in the mail. That's dangerous. Somebody gonna steal that. Like if I saw an envelope full of cash, I don't know, man. I mean, I'd be real tempted. So yeah, don't put physical cash in the mail. Only use checks. If you're sending cash in the mail, use checks. Okay, whether and preferably private company check. Two people are assigned the task of opening the mail in most companies. There's usually more than one person opening the mail in the event that there are checks that we're receiving in the mail. Cashier deposits the cash in the bank, checks in the bank, and the record keeper records the amount received based off of the accounts receivable. Debit cash, credit accounts receivable when you're receiving cash from your customers. Control over the cash payments is very important for the obvious reasons. Require all payments to be made by check. Please check no cash. Limit access to the checks with the exception of those who have the authority to sign them. Remember, when you cash a check or deposit it into the bank account, you got to sign the back of it. Who signs the back of it? Usually one or two people that have the authority to do that. Voucher system. This is related to your discussion board, I think. A voucher system. A voucher is a process by which we verify, approve, and record liabilities in the event of a cash payment. Issuing checks for cash payment verified and approved and record liabilities. What does this mean? A voucher. Think of that little thing that you tear off when you pay your bill in the mail. It's the bottom of the bill. It shows your account number, the payment amount, the date that you're paying it. That is called a voucher. That little pay stub called a voucher. Yeah. Same as when you're receiving cash. Like when you get your paycheck, you get a pay stub. That pay stub is called a voucher. It verifies the payment and receipt of cash. Vouchers are nice. The sender could be cashier, accounting, receiving, supplier, purchasing, requesting, all of these individuals. Yeah. The receivers are the suppliers, cashiers, accounting, requesting, purchasing, supplier requesting, purchasing. We see the process by which the sender sends the voucher. A voucher could be a check, invoice, receiving report, invoice, purchase order, purchase requisition. These are all vouchers. Yeah. Basically, as cash is being moved, being sent and received, there should be an accompanying document with that cash or that check. Petty cash. Man, I hate petty cash. I really do. Such a pain in my butt. Because in accounting, the reason why I don't like petty cash is because in accounting, we need to go through this process every month. At least the hotel, we went through it every couple of weeks. The front desk always had a little bank, like $100 or whatever. We use petty cash to pay for small things, like a shipping fee, minor repair, low-cost supplies. In the hotel, we use petty cash to pay like a cab driver if the guest got left behind at the airport by the shuttle van. Or a guest comes in late and they're hungry and the restaurant's closed. Or a guest, something happened to their clothing. Whatever, like small things, yeah? So we have a petty cash fund to take care of small things like that, small repairs. Oh, the a couple light bulbs burned out at the front desk. Okay, we'll run down to the store and get some new ones. Here's some petty cash, low cost things. So we use petty cash for those types of transactions.
Professor, I have a question.
Oh, yes.
You're saying, if I'm understanding correctly, like at the last minute purchase, is that what petty cash means?
It can be if it's small. Okay, yes. Petty cash is simply cash that's used for small transactions that are last minute. Like if the accounting office is closed, you can't go to them and ask for them for a check because they're not there. So in that case, you might use a petty cash fund to pay for small things.
Okay. See.
Yep.
Thank you.
You're welcome. Yeah, good question. So the accounting office needs to first establish a petty cash fund. The petty cash fund, again, is used to pay for small things in the event the accounting office is closed and they can't write a check. So to first establish the fund, we debit petty cash and credit cash. Yes, they're both asset accounts. Like a Cash App, Dario, what do you mean? I don't think I understand your question. So Dario says it's kind of like how the Cash App, if you want to transfer your funds to your bank, you might have to pay a small fee. So no, they're not the same. That's very different. So fees, bank fees, that's a totally different expense. That would not be petty cash. That's very, very different. So it's not like a Cash App. Well, I'm talking about physical cash. I'm not talking about applications. Like physical dollars.
Like, I have an example. Like, for example, somebody comes to us saying, for whatever reason, they just need some cash for, like, I don't know, for their lunch, like if they forgot their lunch, for example.
Mm-hmm.
And they come to our accounting saying, hey, can I take some, 20, we give them usually like $15, $20 for the lunch. And then whatever is remaining, they bring back. And then at the same time, we do like an employee accounts, like accounts, I think it's accounts receivable where
That's right.
they have to pay us back. So it's
Sure.
kind of like a hold on them to make sure that they actually pay us back whatever they use from those 20. So it's kind of like a, hold
Great
for
example.
whatever reason. Yeah.
Yep. Good example. Yeah, the other example I would give is hotel front desk. They're sending out postcards for whatever reason. They need to purchase stamps. They're not going to run to the accounting office and ask for a check for $5 to go purchase a book of stamps. They're going to go down to the post office with a $5 bill in their hand out of the petty cash fund to purchase stamps. Okay. It's a small transaction that does not require a check. But when they come back, they'll bring the receipt that they used to purchase the stamps with and put it in the petty cash bank. At the end of the month, the accounting office will replenish the petty cash fund. Make sense?
Dr. V,
Nassim.
why do you hate petty cash so much?
It
Sounds like it's a fixer-all.
I think it's just more work for the accountant itself
so
to
much
just,
work.
yeah, just to keep track because it's
It's a
just,
pain in my butt to keep track of all of those receipts and then having to reconcile it and then pay it right back out. I hate it. It requires a massive journal entry sometimes. Like if you have so many different uses of that petty cash fund, you got to create a big general journal entry at the end of the month. It's basically an adjusting entry for all of the respective accounts. I got to debit postage expense. I got to debit transportation expense. I got to debit, whatever other expenses they use the cash for. And then I got to replenish it at the end of every month. It's a pain. That's why I don't like it.
So why can't you just why can't a company call it like expenses not otherwise specified? I just leave it alone at that.
Yeah, but the cash has to come from somewhere. So, the way you have to establish the
You
petty
debit
cash.
cash and you credit expenses then.
Yeah, but if the cash comes out of the bank, right? So, I mean, if you, because otherwise,
Okay, fine. You're right. You credit the cash
Okay.
and you debit the expense. So it's just an expense, correct?
yeah, it really is. But,
Yeah, but we just have to keep in mind it's coming from the company. Like,
exactly. So it's basically a paper trail. It's a way of establishing the paper trail.
All right, fine.
It's a pain, I know.
And so you're making the case that for the accountant this would suck, but for the front office person
Front office don't care.
that would be great.
yeah, they don't
Now-
care. They don't care.
The front office does what they
Okay,
want.
got it. Now
Here's,
it makes sense.
here's an example, okay? Tile cleaning to come clean the the office, the lobby, to come and clean the tiles in the lobby, $46.50. Transportation of merchandise that they purchased, Uber Eats, $15.05. Delivery expense, a customer's package was delivered. That happens a lot at the hotel. $5, got to pay for that. Office supplies expense, or I needed some paper, $4.75. These are things I'm not going to write a check for. I'm going to pay it in cash and then get receipts for all these things, put it in my cash bank, give it to the accounting office, and make them replenish it every month. That's why I don't like it. Because then now all of a sudden I got to do a debit to miscellaneous expense, debit to merchandise inventory, debit to delivery expense, debit to office supplies expense, and a credit to cash, to the petty cash fund. And then then I got to replenish all of that, right? So this is the journal entry I make from all of those transactions. And then, credit to cash. And then to reimburse the petty cash fund, I go debit petty cash, credit cash, and do the whole thing over again every month. Pain in my butt. That's why I don't like petty cash. So yeah. And sometimes it's over or short. They overdrew the petty cash fund or they underdrew the petty cash fund. Then I have to account for that. And most of the time that's because they're missing a receipt. Because sometimes, I purchased that postage. I forgot the receipt. Oh, that means I got to do a debit to cash over and short. Fun stuff. What does the bank do for us? The bank, the JP Morgan Chase, the Citibank, the local credit union. Signature cards, deposit tickets, bank statements, electronic funds transfer, checks, bank accounts. All of these are services the bank provides to us, the business. Deposit tickets, we fill these out when we deposit cash into the bank, like a lockbox, yes. A lockbox is another service they provide. The deposit ticket, I fill it out when I deposit cash into the bank. Looks like this, very similar. Checks. I write out a check to my vendors to pay for my various expenses. The bank statement. At the end of each month, I receive a bank statement. It shows me what happened throughout the month. Checks I wrote, deposits I made, number of checks, number of deposits, the respective amounts, previous balance, previous month balance, ending balance, current ending balance. And it shows me a list of the transactions, right? So I use that information as an accountant at the end of every month. After I've gone through my closing process, I do this thing called bank reconciling. Bank reconciling, what this is I'm matching what's on my bank statement to the transactions I've made throughout that month. All the checks I wrote, all the checks that haven't been cleared yet. I'm validating what's been cleared by the bank and what has not yet been cleared by the bank, and I make adjusting entries based off of the difference. What this does is it ensures what I have my cash balance on my balance sheet matches the cash that's in my bank account at the end of that month. So how do I do it? I add deposits in transit, subtract outstanding checks, add or subtract any bank errors or fees, add interest earned, subtract fees, subtract NSF. What's NSF? Non-sufficient funds. Add or subtract book errors. That's how I reconcile the two together. It's a lot easier when you're actually doing it using an accounting software. In other words, because in my accounting software, when I write a check out, there's a check number. Okay? That check number shows up on my bank statement when it clears. And I match that check number with the other check number that's in my accounting system. I put a little check mark next to it. I reconciled that transaction. I do the same thing with all the other checks. And I also do the same thing with the deposits. The only difference when you're reconciling your bank statement to what your book is interest and fees. Interest and fees. Those are the primary differences. And if there's an error, that would be included as well. So looking at this example, here's my bank reconciliation. Bank statement balance, that's the ending balance from the previous month, plus deposits that are in transit, minus outstanding checks equals the adjusted bank balance. My book balance plus interest plus checks I've received minus bank fees minus other fees equals the adjusted book balance. We see that the two equal. When the two equal, that means the bank account has been reconciled with what is in your accounting record, your software. And that's the whole concept behind it. We're matching what is on your bank statement to what is in your accounting software. That's reconciling. And at the end of that month, the two should be equal. Your cash balance on your bank statement and your cash balance on your accounting software should balance at the end of each month. We make sure that they balance through the reconciliation process. I recommend you do that every month. Do not wait until the end of the year to do all that. So I promise you, you'll make an error somewhere along the way. You'll miss a fee, and it'll throw your balance off. Collection of notes. We receive loans from the bank, debit, cash, credit, notes receivable. We receive interest on our bank's account sometimes, right? Debit, cash, credit, interest, revenue. We have to pay fees for printing checks. It's part of doing business, right? Debit, miscellaneous expense, or if you have an expense account for printing checks, check printing expense, credit, cash. Non-sufficient funds, that's a fee. Debit, a receivable from that customer, because we're going to charge that customer that. Credit, cash. Ratio. I know you guys love ratios, don't you? I'm sure you do. Days sales uncollected. Uncollected means how long it's been since I've collected the accounts receivable from my customer. Yeah? How long it's been sitting in accounts receivable. That's what this tells me. We take the total accounts receivable divided by net sales times 365. That tells me how long it's been since I've received from my customers. Sorry. You can do it individually, I guess. Verification documents. I've told you this this one, I think early on, maybe it was chapter 2 or 3. We track all of our transactions. We back it up, right? We verify our transactions. How do we do that? Through the what do we call it? The paper trail. The paper trail. Through the paper trail, I can verify all my transactions. I have a purchase requisition. I match that to the purchase order. I match that to the invoice. I match that to the receiving report. I take these 4 documents to verify that I received what I paid for. Okay? And that I owe my vendor for that purchase. I keep all of that information together. That's my paper trail. So if I ever get audited by the IRS or by an external auditor, I can verify those transactions. That yes, they actually happened. Here's my invoices. Here's my paper trail, right? All these documents relate to that transaction. The accounting department records the purchase and approval of payment using all of these documents. So earlier I'd given the example of the hotel, right? So as what happens in accounts payable? Accounts payable, that department's responsible for paying the bills, okay? But the controller has to sign the check to pay the bill. Before I sign a check for any reason, I want to see the paper trail. I want proof that this transaction happened before I go signing a check. Okay? So I want to see the purchase requisition, the purchase order, the packing slip, the invoice. I want to see those things before I go signing a check. Now, what happens is the person in accounts payable will take those 4 documents, print out the check for me to sign. They'll paperclip those 4 documents to that check. They'll bring it to me. I'll verify that that transaction happened, and I'll sign the check. That process is a way to validate that the transaction actually happened. It creates the paper trail. So I verify that that information across documents actually happened. The invoice approval is called the check authorization, and it's a checklist necessary for approving invoices and payment. So in other words, I look through those 4 documents before I sign the check to validate them, and that is a part of the process. Now, not all companies do it, but I strongly recommend that they do, because it is a part of internal controls. What about vouchers? Vouchers, yeah, exactly, makes it clean. Clean audit. Vouchers is complete after an invoice has been checked and approved. They're used to authorize recording obligation. Certain information is required inside the voucher, such as name, purpose, what it was for. The voucher is essentially a record of that transaction. Questions, comments, concerns, internal controls.
So, Professor, in my job, we actually call it the voucher cash request, where we basically we get approvals even before like sending out a check. We get approvals from like all PMs, like the project managers,
Sure.
before they even come to us. So if anything's not signed, we don't even bother to even go ahead and process it until we actually verify with everybody before we
Excellent.
actually make a payment. So
That's
I guess
excellent.
that's like more security and due process for if this purchase is actually indeed
Mm-hmm. That's checks and
needed.
balances. Yeah, that's checks and balances all day. Absolutely. No, that's a great process. I like that a lot. Makes it secure. Well done. Any other comments, questions, concerns? Internal controls. No? You're all good? Okay. Now, let's take a look at what's going on this week. Now, remember, it's a very busy week. We are at the midterm stage, right? We're week 4. Week 4 is halfway through the whole course. So remember, it's an 8-week course. Okay, so what have we got going on? You owe me 3 things this week. 3, okay? They must be completed by Sunday night. No exceptions. Must be completed this Sunday night. No exceptions. Please. Here's why. The midterm exam, due this Sunday night. We have a discussion on vouchers. We have a Chapter 8 quiz. And we have the midterm exam. These 3 items must, without exception, be completed by Sunday night. Why? I need to report your midterm grades to the university. Okay, so what does it tell me? You must have them done by Sunday night so I can tell the university what your grade is. So, discussion board. Original response, full paragraphs. Responded to your classmates, full paragraphs. That'll get you full credit on the discussion board. The Chapter 8 quiz, very similar to your other quizzes and exams, a couple of questions related to the chapter. The midterm exam. The midterm exam is 10 questions. It is worth 15% of your total grade. Okay? This is a mix of true, false, multiple choice. 5 of those questions are math-related questions, calculations. It is open book, open note, not timed. It can only be done once. It must be due, must, and I mean must, be submitted by Sunday night, no exceptions. Questions, comments, concerns? Exam covers chapters 1 through 8. Tyler.
I'm sorry. It's just the midterm seems earlier than what I'm used to.
It's a 4-week class, my friend.
This?
There's an 8-week class.
Yeah, this is an accelerated class. That's why
Oh,
we're having
okay.
midterm early.
Yep.
Okay.
When you take the final exam for this class, that's when you'll be taking your midterms for your other classes.
All right.
Remember, it's 8 weeks. It's half a semester.
That makes sense.
Yeah, you got it. It's all good. I know it does seem early. Yeah, believe it or not, we're halfway through our 8-week class. Angel,
All right.
Since we only have
one shot.
one shot at it, is it possible we can glance at it today to see what we're getting into?
I'm sorry, is it possible what?
You can show us what we're getting into.
You want a preview? Look at you. Okay. Here's what it looks like. There are 10 questions total. Mix of true, false, multiple choice. 5 of those questions are mathematic questions. Okay? Don't miss any of them. It's open book, open note. Open book, open note. Okay? 10 questions, mix of true, false, multiple choice. They cover chapters 1 through 8. Open book, open note. You can open it. You can save it. You can come back to it. Just don't click submit until you're ready.
Oh, okay. Okay, so pretty much like the rest of them. Okay.
Just like the rest of them, exactly. Yeah, you're right. Questions, comments, concerns? Okay.
No, I think I'm good. Thank you, Professor.
Good, great. You're welcome. Okay, if you think of anything, just feel free to shoot me a note. Otherwise, thank you all so much for your time today. I really appreciate all of you and all of your hard work in the class so far. Wish you the best in the midterm exam. I'm here for you 100% of the time, so feel free to call me, set up office hours, email me, whatever it takes. I'm here for you. So thank you all so much for your time. And as always, I want you to stay safe, wash your hands, and do the right things. Catch you later. Have a good one.
Thank you, Professor.
Thank you. Have a good one.